The first one is so like options. I haven't watched all the investing videos that you had made, but I know I had just got into the ETF with the M1 Finance, and I had did the 7 things that you had put through the link, so I had invested in that. But like I wanted to know the big difference between, because I invest in penny stocks as well, but it's really a risk with that as well. But I know options, like how do you feel about that? Like options.
So
like
very
is the risk way higher?
Yeah, I'm not. That's not the game I play. The game I play is basically like short things, right? Whenever I'm investing, my job is to make sure what I'm investing into is going to, in some way, guarantee me more money than I actually put into it. And the safest way I found for that is just through ETF investing, or, for example, index fund investing for the long term. Doing, for example, dollar cost average, doing rebalancing, and so on. Doing option trading is super risky. Doing day trading is super risky. Doing derivatives, super risky. Doing penny stocks, super risky. Junk bonds, super risky, right? So the point is, if I'm making $10,000 like you are right now, I want to make sure I preserve all this money, because when I lose money, it's going to take me a lot more to actually get this money back. Does that make sense?
Yeah, cause I see. I did invest a lot of money into penny stocks because I knew it was a risk. Cause I know I could lose everything. But with the ETF, I put like a good average up another because I know it's a little bit safer. Because it's like it's putting all my eggs in the basket. How you just explained it, and then I forgot how to.
Just follow the 90-10 rule, right? The 90-10 rule says, for example, you put 90% of your money for investing, right, into short things, for example, like ETFs. And the other 10%, if you want to have fun with it, for example, into cryptocurrency or into option trading, or, for example, into penny stock, you can do that if you want to. But usually you want 90%, most of your money, just going, for example, into something that's secured. For example, index funds or that ETF portfolio that you actually have. And make sure the goal is not to invest money once and just like, okay, never invest again. The goal is to make sure you invest the same amount of money every single month. So over time, it builds up to be more and more money.
You've got to stop.